Hey everyone, welcome to Wealth Redefined. I'm your host, Michael Reynolds, certified financial planner and owner of Elevation Financial. And as always, you can find me on the web at elevationfinancial.com. We're talking about the financial news cycle today and why it's working against you as an investor. The financial news machine never, ever, ever stops. Market alerts hit your phone. First thing in the morning, you see all this stuff happening, scary headlines, news networks run real-time tickers around the clock. Social feeds are full of hot takes on whatever moved the markets today. And for some people, it might feel like you're staying informed and staying up on current events. But for most long-term investors, it's really just keeping you anxious. It's really just raising your anxiety for no good reason. So let's talk about this a bit. So first of all, I want to frame the expectation here. News is a business. Its goals are not necessarily aligned with your goals. So before you can understand how to manage your relationship with financial news, be aware of what it actually is. News organizations are businesses. Their revenue depends on keeping you engaged, and engagement is driven by urgency, drama, and fear. Financial news channels need advertisers, and advertisers want viewers, and viewers are attracted to dramatic headlines. That means every down day in the market gets framed as a plunge, and every correction is a crash. These sensationalized words are used on purpose to get you scared and worked up. That framing is really great for ratings and for viewers, but it's not great for your state of mind. So the ideal attributes of an investor are things like patience, consistency, and long-term thinking. And these things are pretty much the opposite of what financial news media is built to deliver. So once you see that tension and you kind of understand that tension and can step back and look at it objectively, it's a lot easier to stop letting the financial news cycle drive your financial decisions. So let's talk about time horizon. So one of the core issues with watching financial news every day as a long-term investor is time horizon. The news cycle runs on a 24-hour cycle. It's just always on, short-term stuff, what's next. But your investment strategy should run on a more decades-long cycle, or at least a long-term cycle. So one thing to keep in mind is the stock market historically has a down day roughly half the time. This means a day in which the market goes down. About half the days out of the year, the market does have a down day. Doesn't mean the market goes down half the time, not at all, far from it. But on half the days of the year, you can expect seeing a down day. And so that means on half the days you check market news, the headlines are going to be, dramatic and unsettling. But if you zoom out to a 5-year window, for example, the odds of a positive return climb to about 90%. If you extend the horizon further, those odds improve even more. So daily market news and long-term investing are just not a good match. They're not in sync. So trying to use one to guide the other can really lead to decisions that can really hurt you. So let's talk about front page risk and bottom line risk. So not every scary headline is actually dangerous to your investments. Kevin Gordon, who is the head of macro research and strategy at Schwab, basically made a statement drawing a useful line between what he calls the front page risk and bottom line risk. Front page risk is a headline that kind of shakes the market for a day or a week, but bottom line risk is whether that headline actually affects corporate earnings over the long run. Most front page stories never turn into bottom line stories. Geopolitical events, political drama, central bank speculation, all that stuff creates noise. But if they don't affect the long-term earning power of the companies that you own in your investments, the market reaction usually fades. The market just kind of gets over it. So a good example is 2022. Energy stocks became kind of a hot trade driven by a Russia-Ukraine conflict and oil prices going up. And many investors responded to that narrative and sold their technology holdings. But the underlying story for technology, which is structural, decades-long growth driven by the digital economy, haven't changed. Those who stayed the course were rewarded, and those who chased the headlines were not. They had issues. The loudest story at any given moment is generally not the most important one for your investments. So what's the real cost of reacting? The danger of too much financial news is not just stress, though that obviously plays a part. The bigger danger is what the stress leads you to do. There's research from Dalbar, which is a firm that studies investor behavior, And they found that the average investor consistently underperforms the broader market. And that is because of one thing: emotional reaction. When markets drop, people sell out of fear. They wait until prices have already recovered before they get back in, and they missed the boat. Over the past 2 decades, every dollar invested in the S&P 500 grew more than 8 times. But if you missed the 10 best days during that stretch, you would have earned less than half of that return. So 10 days out of like around 5,000 trading sessions over 20 years. So according to research from JP Morgan, investors who stayed fully invested in the S&P 500 over a 20-year period grew their portfolios quite a bit, while those who tried to time the market based on news events fell pretty far behind. And to make it worse, many of the market's best days happened during its scariest headlines. The investors who moved to cash when things felt scary and dramatic were often the ones who missed the recovery altogether. And here's the thing: social media makes this even harder. Mainstream financial news definitely has this risk, but social media is even worse. A 2023 survey by Nationwide found that 34% of investors between ages 18 and 54 had acted on financial information from social media that turned out to be factually wrong or misleading. Social platforms are built to generate strong reactions, just like the news cycle. In a financial context, that usually means fear, excitement, outrage. All of these things are not very useful when making investment decisions. So if your market signals are coming from your social feed, that could be a problem. So how do you actually manage news intake? How do you deal with this? So this doesn't mean you have to just go dark and just ignore everything. Staying informed can be useful, but you want to be more intentional about how you consume media. So one thing that could help is, keep the front page out of your investment process. Any story that genuinely matters to your portfolio is going to show up in, business and financial reports related to earnings. Things you don't need to be monitoring every major news outlet to stay in the loop. Also, put yourself on a media diet. Only you can control, the quality and the quantity of the media you consume. That's up to you. So if you avoid the temptation to doom scroll every piece of news that claims to have the answer on what's going on or claims to have some doomsday prediction, you can shut that off. You're in control. Also, ask the right question when a headline is stressing you out or seems worrying. Ask whether it's likely to affect the long-term earning power of the companies that you own. If the answer is probably not, then you may not have as much to worry about as you think. Also, call your financial advisor if you have one. If something feels serious enough to act on and you're tempted to make some change or do something drastic, reach out to your financial advisor and talk it over. That can often kind of give you some perspective. That's what they're there for, to help you guide you through these things and help you navigate this kind of stress. So with all that said, don't swing too far the other way. Tuning out the noise doesn't mean assuming that everything's always fine. Excuse me, markets do go down sometimes significantly, sometimes for a long time, and it can feel very scary. Bad years happen, and that's normal. That's a normal part of investing. Investors should avoid making emotional decisions based on short-term conditions in either direction. Not just when the news is scary, but also when the market is going up and everything feels great. Don't get lulled into a false sense of security, because the market does sometimes go down, and that is a normal part of investing. So be aware. Don't let the news cycle stress you out, but be aware that sometimes the market goes down, and that is a normal part of being an investor. You have to kind of ride those out to get the rewards of long-term investing. So what actually makes a difference? The most important decisions that you can make are often the ones that involve not doing anything. So, staying invested when the news feels scary. For example, not selling in March 2020 when things felt terrible. Not chasing the hot trade because everyone on social media is talking about it. Long-term investing involves some really boring stuff like discipline, consistency, fighting the urge to sell when everyone else is selling, and staying the course when markets get uncomfortable. And often you'll see things saying, "Oh, your advisor is telling you to stay the course," and they don't know what's going on. Like they're trying to sell you something or scare you into doing something. Staying the course feels very boring, and often sensationalist headlines and sensationalist influencers will criticize the mindset or the perspective of staying the course, and they'll act like it's old-fashioned, outdated, and irrelevant. And you're supposed to do something because they know something you don't. Wrong. Staying the course historically has proven to be the winning strategy. And it sounds boring, and it sounds like you should be doing something different, but that's what works. So, don't look at every news headline and feel like you have to act on it. I think I've said enough there. So, it takes effort and takes discipline to do this, but it's the news cycle is not designed to help you be a long-term investor. Keep that in mind. The news cycle is designed to scare you, to create drama and urgency because they want viewers and advertisers and traffic. So keep that in mind and separate what's happening on the front page with what your actual investment strategy is, and you are much more likely to be rewarded for that discipline. So, as always, you're welcome to reach out with questions. If you want to talk this over, feel free to reach out. You can find me on the web at elevationfinancial.com. If you're not already a client and you'd like to consider becoming a client, you are welcome to book a free consultation, and we can chat for 45 minutes or so. No pressure at all. I don't do salesy stuff. I don't try to get you to become a client if you don't want to be. I just answer your questions. I'm happy to chat. And if you want to move forward, that's great. If not, totally fine as well. So you won't have any pressure from me if you want to schedule a consultation. So elevationfinancial.com is where to find me. Thanks for joining me. Have a great day. See you next time.